Chapter 4, completing the accounting cycle. Learning objectives: prepare financial statements, including the classified balance sheet. Use the worksheet to prepare financial statements. Explain the purpose of journalize and post-closing entries. And prepare the post-closing trial balance. We're going to describe the accounting cycle. Use the current ratio to evaluate our business's performance. And we're going to explain the purpose of journalize and post-reversing entries. So first, we're preparing our financial statements, including the classified balance sheet. So how do we prepare financial statements? Well, we've been looking at our assessment, and that's actually what we're doing in our assessment. We are preparing our financial statements. So there's different types of financial statements. There's different reports. There's the income statement, statement of owner's equity, the balance sheet, and the income statement reports our revenues and our expenses. And it calculates our net income or our net loss. The statement of owner's equity shows how capital changed during the period. And the balance sheet reports our assets, liabilities, and stockholders' equity as of the last day of the period. So, income statement is for the period. So you may see an income statement for January or February or March, or the whole entire year, January through December. Or like we talked about last week, some companies, their annual fiscal years are not January to December. Some of them are July to June. So it just varies depending on the company. But these are, the income statement is for a particular period. The statement of owner's equity is during the period. The balance sheet is the last day of the period. So the balance sheet is whatever the last day is that you're looking at. So in our assessment, we're looking at December 31st. So that would be our balance sheet. So how do we prepare these? The financial statements are prepared starting with a trial balance, making our adjustments. Then we have our adjusted trial balance. And so we see here, this is an example of the adjusted trial balance. It's on page 185 in your book. And this is just showing you what that adjusted trial balance is supposed to look like. So it's a good reference for your assessment if you are still having some items that you're needing to go back and look at. This is a good reference as well. And then the financial statements relate to each other. So we also, I mentioned this before in a previous class, but they relate to each other in net income or net loss from our income statement flows into our statement of owner's equity. Ending capital from the statement of owner's equity will flow into the balance sheet. And we'll see this in our assessment when we're creating our income statements, our balance sheets, our statements of owner's equities, cash flows. And you'll also see this in the example on the next page, on page 186. So here we have our income statement. We know income statements they hold our revenues and they hold our expenses. And so we have our revenues listed out first because that's the money coming in. And then we have our expenses listed second because that's the money going out. We're going to put the totals of each expense account to the left side of our income statement. And this is just to show a breakdown of the expenses and what those totals were. But then we're going to total all of our expenses up and place that to the right-hand side to total out our revenues and to total out our expenses. So if we had more than one type of revenue, we would have another revenue account listed here. But in this example, we only have one revenue, and so we have service revenue, $17,500. But we have multiple expense accounts. So we're going to list out each of those expense accounts. We're going to place the balances that are in each of those expense accounts as of or for the 2 months ended December 31st. So these are the balances. And then we're going to add all of this up to give us our total expenses. And then we're going to take revenue minus expense equals net income. So this is our net income. Net income comes from the income statement. So now we have our net income, and net income then is going to flow over to our statement of retained earnings. These are really good slides to use for your assessment. So now here we see our statement of retained earnings. We have our retained earnings as of November 1st was 0. And then our net income for the 2 months is $8,550. We're going to add those together. We're going to take out our dividends. Our dividends were $5,000. So our retained earnings for December 31st is $3,550. The net income from the income statement flows to the statement of retained earnings. You see that here. And the ending retained earnings flows to the balance sheet. So if our income statement is wrong, this $8,550 would then be wrong. So then our statement of retained earnings would be wrong. So then this total would then make our balance sheet wrong, right? So it's very important that we get our worksheets, that we understand what's going on in our worksheets so that we can ensure that our reports are accurate. So we're taking the statement of retained earnings, we're taking our retained earnings of $3,550, and we're going to bring that over to our balance sheet. And so here we have our balance sheet. On the balance sheet, it holds our assets, our liabilities, and our equity. So we have all of our assets listed out on the left-hand side, all of our liabilities and equity listed out on the right-hand side, kind of like the accounting equation, assets equal liabilities plus equity, assets equal liabilities plus equity. Our asset side has to equal our liability and equity side. We've listed out all of our assets here. So cash, accounts receivable, office supplies, furniture. We're going to take out any depreciation. Same down here, less depreciation. We're going to total all of this up, and it's going to give us our total assets. Liabilities, we're going to bring in all of our liability accounts, add those up. This gives us our total liabilities. And then our stockholders' equity, we have our common stock, we have brought over our retained earnings, and we're going to add those to get our total stockholders' equity. And then we're going to add those to get our total liabilities and stockholders' equity. So the 62 plus the 51 gives us our total, the liabilities plus the equity. And so both of these have to balance out. The ending value of our retained earnings from the statement of retained earnings flows into our balance sheet, and we see that here. Does anyone have any questions on any of that? How the income statement and the balance sheet, statement of equity, all of that flows together? Okay. It's a really good place for you to use to set up these reports when you are doing your assessment, and to also refer back to when you're working on your homework and your quizzes. So a classified balance sheet places each asset and each liability into a specific category. Assets are shown in order of liquidity. Liabilities are classified as current, due in 1 year, or long-term, due after 1 year. So anything that's due within 12 months is current, and that's liabilities, and that's for liabilities. So they're called current or short-term. Anything due within 12 months is current or short-term. Anything after that would be long-term. Liquidity, we mentioned this in a previous class. Does anyone remember what liquidity is?
Liquid access, isn't it?
Yes, how quickly you can convert something to cash. So what's the most liquid asset that we have? Cash. And not necessarily the most is unliquid even a word? Not really. So the least liquid asset that we might have would be land. And that's because it's harder to sell land than it is to get cash. So liquidity is how quickly we can convert something to cash. So it's probably quicker for us maybe to sell like a desk than it is to sell land. So furniture would probably be more liquid than land. So when we're talking about assets, we have current assets, long-term assets. Current assets, these are normally assets that can be converted to cash or used within 12 months or within the operating cycle. Current within 12 months. Long-term assets are not converted to cash or used up within the operating cycle or 1 year. So some examples of long-term assets would be long-term investments, plant assets, and intangible assets. The operating cycle is the time span during which cash is paid for goods and services, which are then sold to customers from whom the business collects cash. And then liabilities, same type of logic. So current liabilities must be paid within 1 year or the operating cycle of the business. Some examples of current liabilities: accounts payable, salaries payable, unearned revenue. Those are normally always current liabilities. And then long-term liabilities are liabilities that do not need to be paid within 1 year or within the operating cycle. So these are liabilities that can extend past 12 months. Stockholders' equity represents the stockholders' claims to the assets of the business, reflects the stockholders' contributions to the business, the net income or net loss of the business, and owners' withdrawals. It represents the amount of assets left over after the corporation has paid its liabilities. And so here on this next slide, we see the classified balance sheet. Where is it? Right here. So it's also on page 188. If you want to look in your book. So on the classified balance sheet, the classified balance sheet only includes 2 asset categories. You have current assets and plant assets. Other categories that could be included in a company's assets section are long-term investments and intangible assets. So here we've broken out in our classified balance sheet, we've broken out our assets, and we have classified them based on current or long-term. So now we have here we go. So we have our current assets, and then we have our plant or our long-term. We have our current liabilities, and then we have long-term. So we have broken out the assets and the liabilities. That's the difference between the balance sheet and the classified balance sheet. We are classifying on the classified balance sheet, and we're classifying between current and long-term. Are there any questions on that? No? All right, so there's a try it on, actually, let me see. I just skipped one. Yep. There is a try it on page 189. I'm gonna give y'all a couple minutes to look at these and try to identify, and then we'll go through them.
So 189.
189, yes. Does anyone have number one yet? Y'all need a few more minutes. I'll give you a few more minutes. All right, I'm going to go ahead and, so number 1, for each account, identify the category in which it would appear on a classified balance sheet. So we talked about classified balance sheet. We have assets, and then we also have the liabilities. They're both broken out into current or long-term. So for patents, did anyone have an idea of the category that patents would fall under? What is a patent? So that's a good guess. That is good. I think this is probably the most tricky one. So a patent is actually something that is not seen. So it's not like land or a building. So a patent is actually going to fall under intangible. So that would be an intangible asset. That one's tricky.
As long as you can't physically touch it, it counts as patent.
Yeah, so like a patent would be intangible because it's still an asset.
Money in the bank.
But-
in the bank.
Well, so cash would be considered a current asset, but a patent would be, it's something that you can't like physically touch, but it is still an asset for your business. So,
LLC.
I'm sorry.
Like an LLC.
Well, like
Like the brand, like maybe the name.
like maybe like a what is it? It's not copyright.
Trademark?
Yeah, it's like a trademark.
Okay.
Kind of like a trademark. Yeah. So those are intangible. They are still assets, but you can't physically touch them. But you could sell them, even though they're not physical.
Okay.
What about a mortgage payable due in 5 years? A mortgage payable, so we're identifying the category on the classified balance sheet. So let's just go to the classified balance sheet. Don't we have, here. Can you see that?
That'd be a long-term liability.
Yes. That would be a long-term liability. It won't let me make this larger. Oh, wait, hold on. Oh, I know. Nope, that didn't work either. Can you see it okay on the screen up there at the balance sheet? It's kind of small on my screen, but you can also look in the book on 188. So a mortgage payable that's due in 5 years, so anything due over 12 months is considered long-term. And it's a payable, so it's either going to be a long-term asset or a long-term liability, and it's due in 5 years. So it's a long-term liability due in 5 years. What about number 3, land? Plant asset. Land is a plant asset. What about number 4?
Current asset.
Current asset. Number 5,
Liability or
current liability. Number 6.
stockholders equity.
Number 6, investments in stock of another company held long-term. Of another company. So that means we have investments in stock.
So that'll be a long-term asset.
Close. It's a long-term investment, but it is very, very close. So we have stocks in, we have an investment in stock of another company. So we have an investment and then we're holding it long-term. So it's considered long-term. Very close. Very good, y'all. And then accumulated depreciation on furniture.
Plant asset.
Plant asset. Good job. So if you have any difficulties identifying those, you can look on page 188. That should help you as well. But y'all did a great job. Good job. Oh, now it's not going to show me where I am. So use the worksheet to prepare financial statements. And we see the worksheet on page 190 if you want to refer to that page. So how can a worksheet help us prepare our financial statements? The first 4 sections of the worksheet, see chapter 3, those first 4 sections help us determine what our adjusted trial balance is, from which we then prepare our financial statements. Section 5 is our income statement, Section 6 is our balance sheet, and Section 7, we determine our net income or our net loss. So the income statement only includes our revenue and expense accounts. The balance sheet includes assets, liabilities, equities, except for revenue and expenses. And when we determine our net income or net loss, the balancing amount for the income statement and balance sheet sections will be the same. So here is our completed worksheet, and we're going to discuss this. Let's see. We have a try it on page 191. I'm going to give you a couple seconds to look at this one. It says for each account listed, identify whether the account would appear in either the income statement section or the balance sheet section of the worksheet. And we've been doing this in our assessments. So you guys, y'all have this. We're going to assume that they have normal balances, meaning that their balance is on the normal credit side or the normal debit side. And we're going to identify if the account would be recorded in debit or credit columns. All right. So does anyone have the first one, service revenue? What account would be recorded, and is it a debit or a credit? So is it a balance sheet account or an income statement account? The service revenue. Income statement. And is its normal balance a credit or a debit?
Credit.
The normal balance is a credit. Let me see. We'll go back one. Okay, so right here. So looking at this worksheet on page 190, we see here we've got our income statement in section 5, the light green, and we have our service revenue account, which is showing in the income statement, and it is showing on the credit side. Its normal balance is a credit. So then for number 9, for accounts payable, where does that one fall?
Balance sheet.
On the balance sheet. And what is its normal balance?
Credit.
Credit. What about cash?
Balance sheet and debit.
Yes. Does anybody not see that? Does anybody have questions? Okay, because I know it can be, there's a lot of accounts on here on this worksheet. So I just want to make sure. So we're looking at the light green and the orange columns, and we're determining either income statement, which is light green, or balance sheet, which is orange. For number 11, depreciation expense on the building. Income statement, and would it be a debit or a credit?
Debit.
Debit, good job. And dividends.
Balance sheet. Debit.
Balance sheet, debit, good job. And then accumulated depreciation on the building.
Income statement. And it's debit.
Accumulated depreciation on the building.
Balance sheet. Balance sheet credit.
Balance sheet credit. Balance sheet credit. So depreciation expenses fall on the income statement, revenues and expenses. But on the balance sheet, that's where we would show our accumulated depreciation. Very good job. Very good job. Are there any questions about that? Okay. All right, so now we're going to explain the purpose of journalize and post our closing entries. The closing process zeroes out all revenue and expense accounts in order to measure each period's net income separately from all other periods. So when we are closing everything out at the end of our 12-month period, we're going to assume December 31st, so we can say at the end of the year. At the end of the year, we're closing everything out. We're closing our books. We have different types of accounts. So different accounts fall into either a temporary account category or a permanent account category. A temporary account is an account that we're going to close out and start over. Permanent accounts are accounts that are going to roll over into the next fiscal year. So for temporary accounts, we have revenues, expenses, owner's withdrawals. Those are all temporary accounts. Permanent accounts, those are assets, liabilities, owner's equity. And let's see. And if you look on page 191, it tells you the closing process is a step in the accounting cycle that occurs at the end of the period, because we're closing out on our assessments. So this is definitely a page to refer back on. Slide number is this? I think I made everything disappear when I was messing around with that thing. Okay, 20. Slide 20. Thank you so much. So slide 20, you're gonna want to refer back to page 190, 191. The closing process is a step in the accounting cycle that occurs at the end of the period. The closing process consists of journalizing and posting the closing entries to set the balances of revenue, expense, income summary, and dividend accounts. Temporary account is an account that relates to a particular accounting period and is closed at the end of that period. Revenues, expenses, income summary, and dividends are all temporary accounts. And if you flip over to the next page, 192, so permanent accounts, on the other hand, these are also known as real accounts. These are the asset, liability, common stock, and retained earning accounts. They are not closed at the end of the period. Permanent account balances are carried forward into the next time period. So temporary accounts are closed out at the end of the period. Permanent accounts roll over into the next period. Closing entries transfer the revenues, expenses, and dividend balances to retained earnings to prepare the company's books for the next period. This transfer to retained earnings also causes retained earnings ledger account to now equal its balance reported on the balance sheet. As an intermediate step, the revenues and the expenses may be transferred first to an account called the income summary. The income summary account summarizes the net income or net loss for the period by collecting the sum of all expenses as a debit and income or net loss. They collect the sum of all the revenues as a credit. The income summary account is like a temporary holding tank that shows the amount of net income or net loss of the current period. Its ending balance, net income or net loss, is then transferred or closed to the retained earnings account, which is the final account in the closing process. And so we see here, let's see, is this the next slide? So we already talked about this. So closing entries transfer revenues, expenses, and owner withdrawals to the owner's capital account. Revenues and expenses may be transferred first to an account titled income summary. The income summary account summarizes the net income or net loss for the period. And so here, this is also on page 192, we have a diagram of the closing process, which we're doing in our assessment. So the closing process, we see here, we have expenses. We have a debit to expenses. To close this account out to the income summary, we're going to credit it and we're going to bring it over. We're going to debit our income summary here because whatever happens on the right side has to happen on the left side. So we're debiting, we're crediting, and we're debiting to bring this amount over to our income summary, and the final result of this will be 0. So now we have our income summary, we have expenses. We need to bring in our revenues as well. So our revenues, we have a credit. So to zero this out, we're going to debit our debit our revenues. So we're going to debit our revenues to close this out, and we're going to bring this over to our income summary. Since we debited here, we're going to credit here. So we're going to credit our income summary for our revenues, and then That's going to then bring down our net income. We're going to close this to our owner's capital. So we're going to debit, bring it down to owner's capital, credit, owner withdrawals. We're going to clear out this account as well. So whatever amount of debits and owner withdrawals there are, we're going to credit for that same amount to zero this account out. And we're going to bring that over to the owner capital account as well. And so now in owner capital, we have our beginning balance of whatever that was. We've included our owner withdrawals that came from here. We've brought in our net income, which came from our income summary. And now we have our ending balance of owner's capital. So this is a diagram to just show you the flow. This may be easier to look at when you're performing the problem that relates to closing everything out. This is a good reference for you to go to see where you're moving different accounts. So that's a good slide to refer to, slide 22, and then page 192 in the book. And then closing temporary accounts. So in this example, let's see here. As stated previously, all temporary accounts are closed or zeroed out during the closing process. This is page 193. Revenue, expenses, and dividend accounts are not permanent. Only the balance sheet accounts are permanent. The 4 steps in closing the books follow. So first, you're going to make the revenue accounts equal 0 by using your income summary. This closing entry transfers the total revenues to the credit side of the income statement of the income summary. For example, Smart Touch Learning has a $17,500 credit balance in service revenue. So we have this amount in our service revenue. If we are closing the service revenue account, we have to have a 0 balance in that account. All temporary accounts, we are zeroing out the account. This is our goal, to have a 0 balance. So we currently have $17,500 in our service revenue account. To zero this account out so that we can start fresh in the next year, we're going to have to do the opposite of whatever's going on. So in this case, we have a credit, so we're going to debit $17,500. That's going to zero out our service revenue account. Well, we have to put this somewhere. We're going to put it in our income summary, and it's going to be a credit in our income summary because whatever happens on the debit side has to also happen on the credit side somewhere to keep everything in balance. So since we debited service revenue, we're going to credit our income summary. This is what you're doing in requirement 6. So this is a good slide to refer back to. And then you're going to journalize this. Yes, sir.
Okay, based off the assessment, so if I was to do the service revenue for the closing entry, to close the account, I would have to move the service revenue to a debit in order to close it.
Okay.
Because service revenue is technically already a credit.
So if it's a credit, then you would debit.
Okay.
If it's a debit, you would credit because you're zeroing out the you're just zeroing out the account. Yeah. So we've zeroed out our T account, and we have to create a journal entry to show what we did. So we're going to debit our we debited service revenue here, so we're going to debit service revenue in our journal entry. And we're going to show that we credited our income summary. We always list debit first, credit second. And then the note here is to close our revenue or to close revenue, service revenue, whatever you prefer. And just remember when we talked about this, the notes should be they should be short, but they need to also explain whatever's going on. So this is a rather simple, I know to you guys, you're probably like, no, it's not. But there are some very complex journal entries that, you know, moving this from here to here because of, or refer to. So you want this note to be simple, but still detailed enough so that if someone comes in behind you that doesn't know what's going on, they can read your note and they'll know where the service revenue came from. What you put it in income statement summary, why? Oh, because you were closing revenue. This is a good slide as well. So for this one, let me get back over here. This is showing everything that we did in our expense accounts. So we just closed out our revenue. We only had one revenue account, service revenue. We closed out our service revenue to the income summary. We're done. Okay, that's that like first transaction that we're going to do on our closing entries. And then our second transaction, we're closing out all of our expenses, our second journal entry. So when we're closing out our expenses, we're actually going to debit the income summary, right? Because over here we credited it with revenue, so we're going to debit with expense. Because revenue is income and expense is expense. So it's going to be the opposite, whatever the opposite is. So here we have our income summary. And this amount we actually probably currently don't know. So we're going to leave that blank on our assessment. And then we're going to go in and we're going to pull, okay, well, rent expense, we have to close rent expense out. So we're going to credit the amount that's in rent expense. In this example is $3,000. We have to clear out our salaries expense. So we're going to include the salaries expense, supplies expense, utilities, depreciation expense, depreciation expense for the furniture, the building, interest expense, all of our expense accounts. So now we've added in all of the expense accounts and the total balance in each of those accounts. So we're just going to add these up. What's 3,000 plus 4,800 plus 400? So we're going to add all of these up. That's going to give us the total amount of money that we need to debit our income summary for. And so now we know we're debiting our income summary for $8,950. And then we're going to make a note. This is to close our expenses. Does anyone have any questions on this one? Okay. So you have this example from chapter 3, the try it. So these are all your income statement accounts. So if we were closing these out, what would we do with this? With revenue. To close out revenue and zero the balance for the next year. If we're crediting 23 here, we would debit 23 to clear out the revenue. For our expenses, we currently have $10,485 in expenses. If we're debiting our expense accounts and they currently have this balance as a debit, to zero those expenses out for the next year, we're going to credit the expense account to zero it out. So we would credit rent expense for $3,800 to zero that out. And if we credit rent expense to zero that out, what is it going to be on our income summary? if we credit rent expense to zero rent expense, what will we do to our income summary? The opposite. So if we're crediting rent expense, we're going to debit the income summary. And so now our rent expense account has nothing in it. So we have rent expense. Expense. And we currently have a debit of $3,800 in rent expense. Well, we also have our income summary, and now we're at the end of the year. So let's say this is on 12/30. Well, actually, it's still 12/31 because we're closing this out. So we have this balance in our rent expense currently. We're closing everything out. We're closing our books. So we have to, this is a temporary account. Which means it has to equal 0 at the end of the year, because tomorrow on the 1st, discount's going to start all over. So to close out rent expense, what are we going to do?
Credit.
We're going to credit it for that same amount. And now there's nothing. It's 0. There's nothing here. This account is now closed. But we have to do something with this $3,800 because it can't just go nowhere. So we're going to move it to the income summary because that's the account that we use to close out all of our temporary accounts. But what are we going to do with it on the income summary? Are we going to, so for our closing entry, this is debit and this is credit. So for our closing entry, we credit rent expense to 0 this out. So since we credited rent expense here, we're going to do what to the income summary? Debit, because our debits and our credits have to equal. So we're going to debit the income summary by $3,800 because debits are on the left, credits are on the right. So that's the debit side and that's the credit side. And so that's how you're going to create the closing entries on your T accounts. And then, so this is the rent expense. So then the next one we see we have salaries expense, and I'm just going to put it on here so that you can see. So rent expense was $3,800. So salaries expense on our example is $5,375. So it would also go here because it was a debit on the income statement. So we're going to credit to clear, and then we're going to debit income summary to put it on the income summary. And so then after we have made all of the adjustments for all of our temporary accounts, we're going to see several different accounts listed in our income summary. And then we'll total that up to whatever that amount is. And we'll either have a debit amount or a credit amount in the income summary. And we're going to talk more about this. But I just wanted to give you an example like the example that you already have so that you have something to look back on. So the income statement in our example that we used last week, okay, you can't see that. That's how you would set these up here. And the result, you would have a debit to your income summary and a credit to each of your expense accounts for the amount that was in those accounts that you have now cleared out. So like the 3,800 would be the amount that you would list for the rent expense account in the example that we have on the board. So here we're looking, we have the T account for the income summary. Close 1, close 2, close 3, these are just giving us references to where these numbers came from. So the first example that we completed was the 17,500, which was the revenue. And then the second example that we completed was the 8,950, which is our expenses. So that's showing you our revenues here, our expenses are here. This is the current balance in the income summary account, 85,500. Then we're going to, why didn't they give us, hold on. I need to read your stuff through the book. All right, so the next step. So that was, so now step 3. So step 3, it says make the income summary account equal 0 via your retained earnings. So this closing entry transfers your net income or net loss to the retained earnings account, which is here. So Smart Touch Learning has an $8,550 credit balance in the income summary account. This represents the net income for the period. Net income will now be transferred to the retained earnings account. We will debit the income summary and credit retained earnings. So we're debiting out of the income summary here. This is what close 3 is, which is on page 194. And so since we're debiting out of the income summary, we're going to credit into retained earnings. Notice that this closing entry, in effect, increases the retained earnings account for the net income period. So now our income summary has been zeroed out. We have closed that out. We took all of our revenues and expenses and we pulled them together into the income summary. And now we're closing out the income summary and putting it all in retained earnings. So we've zeroed out the income summary, moved those amounts over to our retained earnings account. So now retained earnings has the $8,550 in it. And we're going to create a journal entry to show that transaction. The journal entry, we have a debit to income summary because we debited our income summary. And we have a credit to retained earnings because we credited retained earnings. And then in step 4, so we're going to make the dividends account equal 0 via the retained earnings account. This entry transfers the dividends to the debit side of the retained earnings account. So Smart Touch Learning has $5,000 debit balance in the dividends account. The account will be closed with a debit to retained earnings and a credit to dividends. So we have our retained earnings account here. We're going to debit that $5,000. We're going to credit the dividends account by $5,000. So now our new balance in retained earnings is $3,550 and dividends is zeroed out. We have closed that account out. We're going to make a journal entry for that. Debit retained earnings, credit dividends to close dividends. And then we've got the 5,000 debit and the 5,000 credit. Journalizing and posting closing entries. This example is on page 196. So when a business uses a computerized accounting system, the software automatically closes the books. The software identifies the temporary accounts and records the closing entries and posts to the ledger accounts. The closing entries are completed in a matter of seconds. So all this is done for you if you use a particular software. However, if your information in your software is wrong, all your entries are going to be wrong. So you still have, so one thing I will say, just throwing this out there, I know some of you are entrepreneurs, own your own business, want to own your own business. It is very, very, very important that you structure your financials as accurately as possible, as early as possible. So if you have a business and you are going to use QuickBooks to do your bookkeeping, you need to make sure that you structure your chart of accounts based on what you want it to look like. You have different expenses coming out of the proper expense accounts, and that you keep up with entering your information into those accounts. Don't have like a stack of invoices laying somewhere and then you can't find half of them at the end of the year. It's very important to do that, because if you don't, it is a headache for you, not just your accountant or your bookkeeper, but it's a headache for you as well, because a lot of stuff can be written off. Your tax, you can get tax breaks. You can, instead of owing a ton of money at the end of the year, you can owe less money at the end of the year as long as your books are in order. And I've seen a lot of people that pay a lot of money to have somebody fix their books because they weren't in order. And you don't want to fall into that category. I'm just throwing that out there because it's a headache for a lot of people, and a lot of people, tons of people start and they don't think about that because they're like, really, I don't care about all that. I don't need that right now. And then later on, they're like, oh man, I probably should have, because they're paying for it in the end. Because now they're having to pay somebody to come in and fix all of it, and it can get really hard for them. So keep all your stuff, set it up correctly. You're learning how to do it here. So you're learning all the different types of accounts. You're learning about your income statements and your balance sheets, how those are supposed to look. Take what you learned from this class and apply it. And even apply it in your own personal life as well. I mentioned that, like you can have your own balance sheet and your own income statement. I have my own income statement. And I'm sure most of you possibly do. You've got, well, I make this amount of money, that's your revenue. And I have a phone bill, phone expense, internet bill, internet expense, car expense. You just don't look at it as an income statement. But that's really what it is if you're writing this stuff down or keeping it somewhere for you to keep track of.
So when the accounts payable, is that like bills?
Mm-hmm. Things that you owe. So you might have, you're like, okay, well, I have this account payable. This is something that I owe. It depends on what type of payable or what type of expense it is. But same thing, you can apply this to your personal life. And if you do, it may actually be like, wow, I didn't realize that things look that good, or man, I need to work on this. Because your finances are the business of you. So you can apply it. So don't fall asleep. I promise you will use this again. It just may not be called the exact same thing. All right, so this example on 196 is very similar to your closing entries for requirement 6. So refer to 196 when you're completing your closing entries. I'm just going to put a note here. Page 196. Ugh. So you're going to reference page 196 when you're completing requirement 6. And we've already discussed each of these, so I'm not going to read through these entries. So then this, we saw this, well, not this exact one. So now what we're going to do is we have our income summary. Oh yeah, we did all that because we have our first entry of 3,000, second entry was 5,000. That left us with a balance of 2,000 in our income summary. And then we zeroed out our income summary by crediting 2,000 on the opposite side to zero this balance out. Well, this 2,000 had to go somewhere, so we took the 2,000 from our income summary as a credit, and we debited our retained earnings account. So now retained earnings, we have a debit of $2,000. So our journal entry, we're going to debit retained earnings for $2,000, credit our income summary for $2,000, and this is to close our income summary. Do y'all have any questions? Not at this time. All right. Prepare post-closing trial balance. The accounting cycle ends with a post-closing trial balance, which is a list of the accounts and their balances at the end of the period. After journalizing and posting the closing entries, it includes only your permanent accounts. And we see this on page 198. This is an example of the post-closing trial balance. This is showing all of the accounts that are listed in the post-closing trial balance. And these are also a list of your permanent accounts because the post-closing trial balance only contains permanent accounts. So if you have a question that says identify which accounts are permanent, if you go here, you will look here and you will see that these are permanent accounts. If it says which one's not a permanent account, you can go here and see which one is not listed on here. So just make note of that. And then describe the accounting cycle. Yeah, we'll come back to this one. So describe the accounting cycle. So here we've got this diagram on page 199. First, right here. So first, we're going to start with the beginning balance of accounts. So start with your beginning account balance. And the example they're giving us is accounts receivable. So we're saying that our beginning balance in accounts receivable is $2,200. We're then going to analyze and journalize the transactions as they occur. So we have accounts receivable of $400 and service revenue of $400. So we are going to bring our accounts receivable over and we're going to add the $400 for accounts receivable here because we're only looking at accounts receivable right now. But we had this journal entry where they said, hey, we now have an account receivable of $400 because we performed some service in the amount of $400. So we're adding this 400 to our account receivable. So we have the 2,200 and the 400 sitting in our accounts receivable. And then next we're going to post journal entries to the accounts. We have this unadjusted trial balance. We're going to compute the unadjusted balance in each account, and we're going to prepare the unadjusted trial balance. Then we're going to go down to our worksheet, and we're going to enter the unadjusted trial balance on the worksheet and complete the worksheet. This is optional. Then we're going to make our adjusting entries. We're going to journalize and post the adjusting entries. We have our trial balance. On the trial balance, we're going to prepare the adjusted trial balance. And from the adjusted trial balance, we are going to then be able to prepare our income statement, statement of owner's equity, and our balance sheet. And then once we've prepared those financial statements, we then will go in and we will make our closing entries. We're going to journalize and post the closing entries, and then prepare our post-closing trial balance. This is the very end of, this is using the information at the very end of the day on the last day of our fiscal year. So if December 31st is the last day of our fiscal year at 11:59 p.m., whatever the numbers were, that's it. And then starting fresh on January 1st with our new fiscal year, we would start the cycle over. So that's the accounting cycle. Kind of like explained here. The main reports that we're using, unadjusted trial balance, we see that in our assessment. And I'm hoping that this kind of helps to make more sense, because you've already been working on this in your worksheets for the assessment for the last 3 weeks. This is our fourth class. So I hope that this makes more sense because of that. So you've got your unadjusted trial balance, then we prepare the worksheet, then we receive our adjusted trial balance. From that, we create our income statement, statement of owner's equity, balance sheet. Once we have those, we can then go in and create our closing entries and then our post-closing trial balance. Use the current ratio to evaluate business performance. So the current ratio measures a company's ability to pay its current liabilities with its current assets. To calculate the current ratio, total current assets divided by total current liabilities. Current ratio. So total current assets divided by total current liabilities equals your current ratio. A company prefers to have a high current ratio because that means it has plenty of current assets to pay its current liabilities. So you want a high current ratio. A current ratio that has increased from the prior period indicates improvement in a company's ability to pay its current debts. And you can apply this to your personal life as well. You can take your assets divided by your liabilities, get your current ratio, and you can even compare, year to year. Oh wow, what I was doing was working. I'm getting better at this, or ooh, somewhere I probably need to fix. So you can apply it to your normal life as well. A rule of thumb, a strong current ratio for business, a strong current ratio is 1.5, which indicates that the business has $1.50 in current assets for every $1 in current liabilities. A current ratio of 1 is considered low and somewhat risky. So if you see a question that says a current ratio of 1 or less, 1 or less is low or somewhat risky. And really, honestly, less than 1 would be, I would say, would be risky. Because you're not one-to-one with your assets now and liabilities. Now you're under, so your liabilities are higher. It's going to be harder for you to, if something happened, it would be much harder for you to just hang on to everything, I would think. So That's a rule of thumb. Anything that a strong current ratio is 150, and it indicates the business has $1.50 in current assets for every dollar in current liabilities. Explain the purpose of journalize and post reversing entries. Hold on. I'm marking these. All right, so special journal entries that ease the burden of accounting for transactions in a later period are called reversing entries. They're the opposite of certain adjusting entries. They are not required by GAAP, and they are used for convenience and to save time. To record accrued salaries of $1,200, Smart Touch Learning recorded the following adjusting entry. So to accrue salaries of $1,200, we're going to debit salaries expense and credit salaries payable. And the note is to accrue salaries expense. And then to record the payment of total salaries of $2,400 on January 15th, if we're not using a reversing entry, we would debit salaries payable, debit salaries expense, and credit cash. And this is to record the payment of salaries. So a reversing entry is a special journal entry that eases the burden of accounting for transactions in the next period. So here we have a debit for salaries expense on December 31st and a credit to salaries payable. So we're accruing salaries expense. We owe the money as of December 31st, but we are not paying it. So we're putting it in our payable account. Then on January 1st, we need to go in and reverse that entry. So the reversing entry just reverses the debit and the credit of the adjustment. So on January 1st, we're going to take the salaries payable account. We're going to debit that, the opposite of here. And we're going to credit the salaries expense account here. And this is to reverse the salaries adjusted entry. So it's just the opposite. So do y'all have any questions about any of those? No? Okay. There are, let's see here. We'll go through the practice problems first. All right, so I have this practice problem here. I'll give y'all a few seconds to look at this one. All right, so does anyone have this one?
I'm assuming B.
So Dogwood Inc. earned revenue of 11,000 and incurred expenses of 7,500. The company declared and paid cash dividends of 2,000. What is the balance in the income summary account prior to closing net income? So this is before we close out our net income or loss to retained earnings.
Is it D?
B.
So it's C. Here, I have it on here, I think. This needs to be highlighted.
What happens to the, those are paid for.
So the tricky part is it's, oh,
Prior, yeah.
that's not, it's prior. Now how do I take that off? There we go. So it's prior to closing net income or net loss. And so because it's prior to closing, we're only looking at the revenues and expenses. Yeah. So it's a tricky one. All right, so here's the next one.
A.
Yep. Because the lower, the weaker it is. Correct. Good job. Does anyone have any questions on either one of those? Sorry. No? Okay. All right, so here's the next one. Does anyone have this one?
It doesn't make sense. They say like, in the book it said total current, but then they're saying total and then current.
So a company has 120 in current assets, 600,000 in total assets, 90,000 in current liabilities, and 1,400 in total liabilities. Calculate the current ratio of the company. So how do we calculate the current ratio?
Total current assets divided by the liabilities.
Total current assets divided by total current liabilities. So we're going to take, yep, so that's right. So 120,000 divided by 90,000, and that's going to give us the 1.33. Yep. Does that make sense? Okay, good. Yeah, I know it's tricky because they threw that other stuff in there,
Yeah, the word.
and it's like, what? All right.
Can you go back?
Oh, yes,
Thank you.
no problem. So here's the next one.
Yeah, see.
So a current ratio of 2 indicates the strong ability to pay current liabilities. Because the higher, the better. The lower, the not so good. Good job. All right, here's the next one.
What was I see?
Yeah.
C is correct. So your current ratio is saying you have X for every $1 that you have in your current liabilities. So like we mentioned earlier, that a previous company that we were just looking at had $1.50 for every dollar of liabilities based on because of their current ratio. A couple of slides back. And in this case, they're saying the current ratio is 6. So if their current ratio is 6, then the company has $6 current assets for every $1 current liability. So this company is doing really good. They've got 6 to 1. A 6 to 1 ratio, $6 current assets to $1 current liabilities. All right, here's the next one. Yes.
Oh, it is?
So Rosewood earned revenues of $19,000 and incurred expenses of $4,000. The company declared and paid cash dividends of $1,500. What is the balance in the income summary account after closing net income or loss to the retained earnings? Well, the income summary is where we're pulling all of the temporary accounts in, we're zeroing those out, and then we're going to take the income summary and we're going to zero it out and we're going to move it to retained earnings. So the balance in the income summary account after we close net income or loss to retained earnings is going to be 0.
0 because you're closing it out.
Yep. I already erased it, but yes.
See?
Income summary, right?
Yes. So revenues and expenses are transferred to the income summary account before their final transfer into retained earnings. So we transfer everything to the income summary, and then once everything is combined in the income summary, then we transfer just that income summary over. So B is the correct answer for this one.
B.
It's going to be tricky.
B.
Might be tricky.
No. C. Yeah.
In which of the columns of the worksheet would net income be found? So you can refer back to your worksheet And they're asking, in what columns would your net income be found? So we're going to bring our net income in here. So the answer, the balance sheet credit column and the income statement debit column. All right, and this one.
Is this a repeating question?
It might be. Hold on. I'm like, wait a minute. Which of the columns of the worksheet would net income be found? Nope. They're similar though.
Oh.
They're very similar.
Right.
I'm like, huh? Yes. So net income appears in the balance sheet credit column and in the income statement debit column. Does anybody have any questions about any of this? Okay. That's all the practice problems that I have on here. I wasn't sure if we would have time, so I skipped this one, but we do have time, and it will be really good practice for you because it's something that you have to do this week. So on page 195, there's a try it. If you could please try it, and then we'll discuss it.
On what page?
On page 197, sorry. I think I may have said 195, sorry. I think I may have said 195.